Okay, so just imagine for a second you're standing on the border of the Western world. It's what, January 2026?
Mm-hmm.
And to your left, you've got the United States. And for the last few years, they've been busy building this massive economic wall.
Brick by brick, tariff by tariff.
Exactly. They're trying to keep Chinese influence, Chinese goods, and specifically electric vehicles, completely out. It's a real fortress mentality.
Oh, it certainly is. Fortress America has been the dominant theme. The trend lately has been all about decoupling, protectionism, and a really aggressive version of America First.
Right. But then you look to your right at Canada, and instead of adding more bricks to that wall, it looks like they just took a sledgehammer to the main gate.
A sledgehammer is a good way to put it.
I'm talking about a headline that, it genuinely made me do a double take. While the U.S. is closing the door, Canada just announced this drastic, almost unbelievable tariff cut on Chinese electric vehicles.
It's a move that goes completely against the grain of, well, all of current North American trade policy. It arguably fractures the North American trade bloc.
And that's what we're digging into today. We're looking at a stack of reports, some analysis on this massive new trade agreement between Canada and China. But, and correct me if I'm wrong here, looking at these sources, this isn't really about cars, is it?
Not at all. And that's the mission of this deep dive. We aren't just looking at car sales or, quarterly earnings. We're looking at a fundamental shift in how global superpowers play the game.
A shift.
Yeah.
Yeah.
We're witnessing a reset of relations, and it seems to have been initiated by Prime Minister Mark Carney's recent trip to Beijing.
Mark Carney in Beijing. That is quite a visual, given his background in Western central banking.
It is, and the core question we need to answer for you is, why? Why would Canada/tariffs and cozy up to Beijing when its closest neighbor, its biggest trading partner, the U.S., is doing the exact opposite?
Is this just about getting cheaper EVs for Canadians, or is there something, much deeper going on here?
I think it's much deeper.
Okay, let's unpack this.
Yeah.
Because when I say drastic tariff cut, I really want to be clear that I'm not exaggerating.
No, it's not an exaggeration at all.
Usually when politicians talk about cuts, they mean shaving off 1% or 2%. But we need to look at the numbers here because they are just staggering.
They really are. The headline number is the reduction of tariffs on Chinese EVs. Canada has dropped them from 100%, which is effectively a ban,
Right.
down to just 6%.
100% to 6%. That's not a haircut. That's a decapitation of the tariff.
It changes the entire math. Let's look at the example from our source material to make this real for everyone listening.
Okay.
Previously, under the old, lockstep with America policy, if a Canadian company wanted to import a Chinese EV that costs, say, $20,000 to manufacture.
Which, by the way, is already a pretty attractive price for an electric car compared to what we see on lots right now.
It is a very attractive price. But under the old rules, to import that $20,000 car, you had to pay a $20,000 fee to the government.
Wow. So the base cost doubles to $40,000. And that's before you even add shipping or compliance or dealer markup.
Exactly. So a $20,000 car becomes a $45,000, maybe a $50,000 car on the lot. At that price, it's just not competitive. You're pricing them out of the market on purpose.
The source called it spectacularly unprofitable.
And that's what it was. It restricts competition to protect your domestic manufacturers.
Oh, yeah.
But now, under this new deal, on that same $20,000 car, the fee drops from $20,000 down to just $1,200.
$1,200. That's basically a rounding error in the auto industry.
It's negligible.
So all of a sudden you have these high-tech, affordable electric vehicles that can come into the market at a price that actually reflects what they cost to build. For the average Canadian consumer, that is a game changer. Inflation has been brutal. Who wouldn't want the option to pay half price for a car?
It benefits the consumer immensely, and it certainly benefits Chinese EV makers who need new markets. But before we get too carried away with this idea of a total free-for-all, I have to play the skeptic for a moment. We have to look at the fine print.
Right. The catch. There's always a catch. This is where the government makes sure GM and Ford don't go bankrupt overnight.
Precisely. It's not an unlimited open door. The deal includes quotas. Canada will allow 49,000 Chinese EVs into the market per year.
Okay.
And that number rises to 70,000 over 5 years.
Okay, so there's a cap. But let's be honest, 70,000 cars is still a significant number of vehicles.
It is significant market penetration, but it's designed to be more like a pressure valve instead of a flood.
It keeps the local industry alive, but still lowers prices.
Right. But in any negotiation, especially one this big, you have to ask, quid pro quo? What does Canada get in return? They're not just doing this out of the kindness of their hearts.
Yeah, if Canada's opening its driveway to Chinese cars, what is China opening its kitchen to? Because Beijing usually plays hardball.
Literally, the kitchen. China has agreed to lift restrictions on a whole bunch of Canadian goods. We're talking lobster, crab, and peas. Peas. The source explicitly mentions them.
You know, I feel like we shouldn't just gloss over the peas. I know it sounds a little funny, but agriculture is a massive part of Canada's export economy, especially in the western provinces.
That's a great point. It sounds trivial, but for farmers in Saskatchewan or Alberta, these markets are life or death. But the big one, the real heavy hitter in this deal, is canola.
Canola, the yellow fields.
Exactly. China dropped its canola tariffs from a punitive 84%.
84.
Down to 15%. That is a massive win for Canadian farmers. It restores a multi-billion-dollar trade flow that had been completely choked off.
You know, speaking of canola, I found this little nugget in the research that I actually did not know. I always just thought canola was, the name of the plant, like corn or wheat.
Oh, you caught that bit of trivia.
I did. And it feels so relevant because it's such a Canadian branding success story. Canola actually stands for Canadian Oil Low Acid.
That's right.
It's basically a brand name for a specific type of rapeseed oil.
It is, an engineered crop from back in the 70s. But you're right, it really highlights how this is a uniquely Canadian product.
Canadian oil, low acid, who knew? But back to the strategy. So if we tally this up, Canada gets to sell more lobster, peas, and oil, and in exchange, they get cheap electric cars.
Cool.
What's the total value here?
The export orders for the farmers and fishermen are valued at about $3 billion.
$3 billion. Okay, so that's real money for those sectors. But here's where I have to play devil's advocate. If I'm China, and I'm the second largest economy of the world, $3 billion is, well, it's nothing.
It's a drop in the bucket.
Right. So is $3 billion really enough of an incentive to rewrite global trade policy? It feels like they're giving away a lot of access for a bag of peas.
And that is the pivotal question. To understand China's motivation here, you have to zoom out. You have to look at the volume.
The volume of cars.
Right. Let's look at BYD, Build Your Dreams. They're China's leading EV company. Last year, they sold over 2 million cars globally.
2 million. Okay.
And this deal with Canada allows for, initially, roughly 50,000 cars.
Okay, let me do some quick mental math on that. 50,000 out of 2 million is?
It's about 2.5%.
2.5%. That's statistically irrelevant to their bottom line.
It really is. The analysis we looked at used a very specific cultural reference to describe this. They called it zakat money.
Zakat?
Yes, from the Islamic practice of charitable giving. It's a small percentage of wealth, usually 2.5%, given away without any sweat, just to purify the rest.
So the implication is that for China, this 2.5% volume isn't the struggle, it's pocket change. It's not some economic windfall that's keeping the lights on in Beijing.
Not at all.
So if it's zakat money, if it's basically effortless and economically minor for China, why do it? Why go through all the trouble of a high-profile reset with Mark Carney for 2.5% more sales?
Because if it's not about the money, it has to be about the message. It's about prestige, and it's about symbolism.
Prestige. Okay, so this is a branding exercise.
The geopolitical branding exercise. China is using this deal to market a philosophy.
A philosophy.
Yes, they're pitching a worldview that stands in direct contrast to the United States. Our source material describes this as the clash between win-win and zero-sum.
Okay, win-win sounds like, standard corporate speak. Synergy, paradigm shift, win-win. What does it actually mean here?
Well, think about the imagery used in the analysis. The source describes China's approach as offering a plush cushion and ginseng tea.
Ginseng tea and a plush cushion. That sounds disarmingly relaxing for international relations.
That's the whole point. The pitch is, sit down, have some tea, let's make a deal. You win, I win. And the crucial part, no strings attached.
No strings attached. But is that ever really true?
Well, whether it's true in the long run is debatable, but the pitch is, we don't care how you run your country. We don't care about your internal governance. We are not going to lecture you on human rights or carbon taxes. Just trade with us.
Which I imagine is very appealing to a lot of countries who are tired of being lectured by Western powers. But you said this is in contrast to the U.S. approach, which the source calls zero-sum.
Correct. The analysis portrays the American approach, the whole America First doctrine, as inherently meaning someone else has to be second. If I win, you must lose.
I win, you lose. That's a harsh way to look at an alliance. But looking at the last few years, it feels kind of accurate.
The source gives specific examples. It points to Venezuelan oil, U.S. gets the oil, Venezuela loses sovereignty. It mentions Greenland. And crucially for this deep dive, it mentions Canada.
Right.
The argument is that Canada was being told to surrender sovereignty to align with U.S. economic policy against China.
So the U.S. is saying, do it our way or else.
Precisely. And the host in our source material used this really striking analogy for it. He compared the U.S. sphere of influence to a Netflix subscription.
A Netflix subscription.
Yes. He said, buying is renting. Think about it. When you deal with the U.S., it's like a subscription. You buy the product, the defense umbrella, the market access, but you don't really own it.
Because there are strings attached. You have to keep paying the monthly fee.
And the fee isn't just money. The fee is political alignment, diplomatic support, adopting their economic models. You have to stay within the terms of service.
That is, wow. That's a really sticky analogy. Buying is renting. So if you stop paying that subscription of political alignment, what happens? They cancel your account.
Exactly. Sanctions, tariffs, pressure. The source describes it as, are you outside my sphere? Sanctions. Are you inside? Tariffs.
It's portrayed as a control mechanism. The library gets smaller, and the price keeps going up.
And meanwhile, China's over there with the ginseng tea saying, you buy it, you own it, have a nice day. That is the pitch. And Canada, in this scenario, became the battleground. Canada was effectively being told by the U.S. to block Chinese goods to play a zero-sum game. But China offered a path where Canada could maintain trade, lower costs for its citizens, and sell its own goods without political interference.
And Mark Carney took the tea.
Carney took a tea.
So this brings us to the fallout. Because you can't just take the tea and expect the guy running the Netflix subscription, our biggest trading partner, to be happy about it. The U.S. must be furious.
Unlikely to be happy is probably the understatement of the year. The U.S. reaction is the immediate geopolitical danger here. And it's not just about hurt feelings, it's about cold, hard competition.
Because now, right across your northern border, you've got cheap, high-quality Chinese EVs.
Exactly. The source emphasizes that these aren't just cheap cars, they are high-quality cars. So if Canadian consumers start buying $20,000 Chinese EVs that work great, have better range, better software than the Ford or GM equivalent,
then American cars start to look much less appealing. It makes the American auto industry look bloated.
it creates immense pressure. It creates a competitor right next door that undercut the market by tens of thousands of dollars. And you have to remember, the U.S. is trying to build a wall against this very thing. Canada just let the Trojan horse in.
But the Trojan horse isn't full of soldiers.
No, it's full of affordable lithium batteries. And that's almost more dangerous to the American industry. It exposes the fact that their protectionism might just be protecting inefficiency.
So what can the U.S. do? I mean, they can't exactly invade.
They can squeeze. The source compares the U.S. response to mafia-style tactics. Nice economy you have there, shame if something happened to it.
Right.
They could tighten the border. They could threaten the CUSMA agreement. They could put tariffs on Canadian steel again.
So Carney is taking a massive gamble. He's betting that the U.S. is too dependent on Canada to fully retaliate.
He's betting on a multipolar world. He's betting that he can play both sides without getting crushed.
But beyond the car market, what does this signal to the rest of the world, to the global south, to other allies like Brazil or Indonesia?
That is the prestige part we talked about earlier. This deal is a signal. China is positioning itself as the reliable trading partner.
Reliable how?
Yeah.
Because China has a history of arbitrary trade bans too.
They do, but in this specific narrative they are building, they're showing they don't militarize trade in the same way the U.S. is currently doing. The source makes a very specific contrast. China portrays itself as not throwing its weight around or demanding political conformity to American values. They are showing the world that there is an alternative to the American way.
It's a shift in the balance of power.
It is. The analysis suggests the balance of power is moving east. And China is using this deal, this relatively small economic deal for them, to prove a massive point. You don't have to play by American rules to prosper. You can make a deal with us, get what you need, and keep your sovereignty.
That is a powerful narrative. It's almost like they're using Canada as a billboard. Look, even America's neighbor prefers our deal.
Precisely. It undermines the whole U.S. narrative of a united Western front. It shows that the fortress has a backdoor.
Okay, so to recap here. Canada gets to sell a lot of peas, Canadian oil low acid, and Lobster. They get cheap, high-tech cars for their citizens, which helps with the cost of living crisis.
Right.
China gets a massive geopolitical win and a prestige boost that costs them basically zakat money, pennies on the dollar. And the U.S. is left watching its northern neighbor pivot east, wondering if their subscription model is broken.
That sums it up perfectly. It's a masterclass in soft power from Beijing and a high-stakes tightrope walk for Ottawa.
It really is fascinating when you break it down like that. It's never just about the cars.
It is never just about the cars.
So we've unpacked the deal, the math, and the philosophy. But we always like to leave you with something to chew on, something that keeps you thinking after you take your headphones off.
I think the provocative thought here lies in the sustainability of these alliances. The source material used some very strong language, comparing the U.S. approach to mafia-style dominance versus the Chinese win-win Tea Party.
Right, the easy way or the hard way.
Exactly. And the question is, in a world where you have these two great powers offering two very different business models, how long can traditional alliances hold up against the sheer economics of the deal? If one side offers buying as renting with heavy political costs, and the other offers half-price cars and no strings, can ideology really survive the bottom line?
That is the question. When the wallet speaks, does the alliance listen?
It certainly seems like Canada's wallet just spoke loud and clear.
It certainly did. And with that, we're going to wrap up this deep dive. If you want to see the numbers yourself or learn more about the history of Canadian oil low acid, just check the show notes. We've got links to the source material there. Thanks for listening.
Thanks, everyone.